Hey, what's going on YouTube? And welcome back to Tech Conversations. I'm your host Guillermo. It is June 20th. Hope you're all having a great weekend so far. Let me know in the comment section below if you think tomorrow will be a red day or a green day in the stock market. Now in today's video, I want to talk about a very interesting strategy that actually uses another strategy or two other strategies that a lot of people already use. But by combining these two strategies, we can make it even more powerful together. So I'm going to show you guys how this strategy works, how to set it up, and an example. So before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. So let's talk about again what our goal here from this strategy will be, and of course, what stocks we want to be using here. So our goal with this strategy will be to profit from modestly bullish to bullish movement in the underlying stock. Of course, with limited risk. I avoid any strategy that gives us unlimited risk. I encourage you guys to do the same. And so the appropriate market forecast then, since we're going to realize our max profit above the highest strike price that we're going to choose here in a minute, we want a bullish environment, a bullish market for this strategy. And so in other words, the ideal stocks we want to use for this strategy will be stocks that you're bullish on, right? Stocks that you believe will go up in price, or at least for the short term, depending on what expiration date you choose. And so ultimately stocks that are on an upward trend as well. So find a stock you're bullish on, or at least short term. And so let's say for this demo, I'm just going to use ticker symbol F, Ford Motor. So let's just assume and imagine that I am slightly bullish, modestly bullish on Ford Motor in the next couple of weeks. I think this stock will go up. And so let's take a look at how we would then set it up with this stock. Again, this is just an example I'm showing you guys here, so please don't copy this exact same trade. But here we are on the options for Ford Motor. So now that I've found a stock that I'm bullish on, here's how we would set up this strategy. So the first thing, of course, is always to choose an expiration date. And that's really going to depend on what your timeline looks like as far as how long you think it will take the stock to move up. Let's say I think the stock will go up in the next 2-3 days. So I'll just leave it as June 25th for my expiration date. That should work then. Now what we're going to do here is this is going to consist of 4 different contracts. We're going to be using both puts and calls here. And what we're going to first do is we want to first determine what price you believe this stock will be above by on the expiration date. So what's the minimum value that this stock will be at on expiration date? So let's say that with Ford Motor, and again, it's just an example. Let's say I think that there's no way Ford will go under $14 a share by the expiration date of June 25th. So then we're going to go ahead and we're going to start there. So first thing I'm going to do is I'm going to switch over to puts here, and I'm going to switch over to sell. So what I'm going to first do is I'm going to go ahead and sell a put at that strike price. So again, I think the minimum price Ford will go to by the expiration is $14 a share. So I'm going to find the closest strike price to that, which is 14, and I'm going to go ahead and sell a put here. And remember, when you sell a put, you receive a premium. The premium is under the price column here. The premium will be 13 cents per share. Again, there's 100 shares in each one of these contracts. So I'm going to get $13 for selling this put option. So I can go ahead and click on that there. Now, what I need to do is I need to go ahead and also buy a put. And I'm going to buy a put where the strike is under the strike of the put that I just sold now. And it really depends on you. I'm just going to go right to the next one that's right below it, 1350 strike, and I'm going to buy this put. Now I'm going to buy an option. You have to pay the premium. You have to pay 6 cents per share here, or $6 to buy this put option. Now this is a put credit spread. A lot of you guys are familiar with this, right? A lot of people enter credit spreads. Here's a put credit spread. We're going to receive $7 in credit here for this put credit spread. Now we're not done. The thing about this put credit spread is if we take a look, the max profit here is $7. Our max loss is $43. So you're risking $43 to make $7, right? A lot of people really won't find that risk to reward very favorable. So what can we do then to make our risk to reward here a little bit more favorable for us? Well, we're receiving $7, right? For entering this put credit spread, we're going to get $7 in credit. So what can we do with $7? We can do something else that a lot of you guys are familiar with. We can now enter a call debit spread, which is going to be a debit that we're going to have to pay. And we can actually use the credit that we're receiving here from this put credit spread to pay for that call debit spread. So what we're going to do now is enter this call debit spread. So first things first, with the put credit spread here that we've just opened up, or that we're going to go ahead and get a credit for, you need to take a look at the strikes you chose, right? Take a look at the distance between them. So the distance between these strikes is 0.5. When we construct our call debit spread here now, we also need to make sure that the strike prices are the same distance away, 0.5. The other thing that's important here is that we need to find two adjacent strikes now that where the premium difference is as close to $7 as possible, because again, we want to use the credit that we're receiving here to pay for this call debit spread. So let's see how this would look like. So we're going to switch over to calls now, and we're going to first start off by taking a look at adjacent strikes, because again, since the strikes here are 0.5 away, the ones we choose here should also be 0.5 away or right next to each other. And we want to find two that where the premium difference between the premiums is close to $7 as possible. And there's actually one right here, because if we take a look here, these are right next to each other. Strike price difference is 0.5. Premium difference is about $8. So this will be close enough so we can actually use these two. So now we're going to enter a call debit spread. So remember, a call debit spread, you buy a call at, we're going to buy a call at the $15 strike, and then we sell a call where the strike price is higher than the call we bought. So it's going to be the $15.50 strike. So we're going to go ahead and do that. So take a look here now. Now for all four of these, this is going to cost us $1. All that we've done is we've combined a bull call spread and a bull put spread. We're entering a bull put spread. We're getting a credit. We're using that credit to buy a bull call spread. And now for this entire thing, it's going to cost us $1 here. Now you will have to put up some collateral. It'll be $50. If you continue, it'll show you here $50 in collateral, but that's okay. So again, now if we take a look back here, let's take a look at what this looks like. So this is called the double bull spread, because again, this is a bull call spread combined with a bull put spread. The great thing about this is if we look at our max profit, max loss, our max profit now jumped to $49. Remember, with the put credit spread, our max profit was $7. This just jumped up to $49. Our max loss also jumped up, but not a lot, just a little bit more. So you're taking on a little bit more risk to basically make 7 times as much profit by doing this. And again, ultimately in this scenario, you still want the stock to go up, just like you do with a put credit spread. So as you can see, something that's very simple but often overlooked. We can use the credit from that bull put spread, use it to buy a bull call spread, and now our profit is a lot more here. And so when it comes to this, our max risk then, our max potential loss is going to be whatever the highest strike for the call that we or the calls that we have here. So the call that we're selling, the 1550, you subtract that from the low strike of the call. So 15 strike. So 1550 minus 15 is 0.5. You multiply that by 100. That's 50. You add the premium that you're paying, which is $1. So $51 will be our max loss. To find our max profit, our max potential gain, again, you take the high call strike, which is 1550, subtract the low call strike from that. So 1550 minus 15, again, 0.5, multiply that by 100, we get 50, subtract how much this cost, which is $1, and that's $49. That's our max profit. So again, this is the double bull spread here. So now that we understand that, let's head on over to the option strat calculator here. I'm going to show you guys how you can build a strategy from scratch here. Again, this has a lot of lot of different strategies that are already implemented, but let's just start from scratch here because they don't have the double bull spread, and that's fine. So we're gonna go and build a strategy here. So we're gonna set up the same strategy we just set up over there. So let's go ahead and click on create put here. So we're gonna start with the put. So remember, we first started by selling a put at the $14 strike. Now, the first thing you want to do, of course, is make sure that you're on the correct ticker symbol up here, which we are. This is Ford Motors. And then make sure that you're on the correct expiration. We're not. This is July 9th. We'll go back to June 25th. Now, this is a long put, which shows you up here, right? So we don't want to buy a put right now. We want to first sell a put. So what you can actually do is click on flip here, and this will change it to be a short put or selling a put here. So remember, we first sold a put at the $14 strike, so I can just drag this to the left. Here's the put that we're selling at the $14 strike. And now we can add an option. So remember, we're also buying a put. So let's buy a put. We bought the put right under that at the 1350 strike, which is going to be right there. Now we need to go ahead and enter our call debit spread. So we're going to go ahead and add an option. So we'll start by buying a call here, and we'll do that at the $15 strike, which is right there. And then finally, we'll add another option. This is where we'll go ahead and sell our call, and we sold the call at the 1550 strike. So right there. So it's the exact same trade we just set up on Robinhood. This is how you use this calculator right here. So very handy. It's nice that you can just slide things around. And so as you can see, same things that we saw. Net debit, $1, right? This costs $1. Max loss, $51, right? Because again, we are putting up $50 in collateral. Max profit is $49. Gives us our break even. If on the expiration we're at 1501, we break even. Above that, we make money. Below that, we're going to lose some money. Now, chance of profit and a couple of other things are locked. I believe you need to upgrade for those. But again, you can kind of switch or move around the chart range. So, if I go up, it'll show me more values in the chart range. If I go down, it'll show me less values. So it really depends on what you like it, but I'll just, how you like it, I'll leave it here at the plus minus 9%. I'll leave implied volatility alone. Again, remember, you can switch this over to be a graph if you'd like. And so this is days until expiration 0. So this is on Friday, June 25th. Ultimately, you can go ahead and take a look at, for example, if, Ford Motor goes up to 1520 on the expiration. According to this, I'd make about 1921, right? Or if it goes down to, let's say 1360 on expiration, I'd lose about $40. So this is also pretty nice here. And again, you can switch around, how many days until the expiration here to give you a better idea, better visual of it. But I'll go back to the table here. The other thing, of course, is you can switch over, instead of showing the dollar amount that you would make or lose, you can switch it to be a percentage return. So as you can see, if we make our max profit, according to this, that's a 4,900% return. Down here, it shows you, 100% or it's a negative 100% return depending on where it's at here. So really nice, really awesome to use this one here. Very easy to just kind of, mess around with the expiration, switch around the strikes here and anything here. So anyways, this is the double bull spread. And again, ultimately, we are bullish on here because we want the price of the stock to go up, as you can see from the chart here. Again, our break even above 1501 on the expiration date. Again, you don't have to wait until the expiration date. You can definitely close out before. So for example, if it's 1476 on June 23rd, according to this, you'd make about a $7 profit. If you want to close out at that time, you certainly can do so. So anyways, if you have any questions about that, let me know. Now, a couple of other things to note here. One, there are 4 different contracts here. We're opening 4, we're closing 4 contracts. So, if your broker has commission fees, that might eat away at your profit. Robinhood doesn't have any commission fees, so we don't have to worry about it there. But there are brokers that do have some pretty high commission fees. So make sure you're always taking a look at that and, know how much it's going to be ahead of time, and still make sure that your risk to reward is favorable. The other thing, of course, is risk of early assignment. So anytime you sell an option, there's a risk of assignment. We are selling a put here. We're selling a call as well. Now, being assigned before the expiration date is rare. It does happen. And most of the time, the reason for early assignment before the expiration date is due to the dividend and the ex-dividend date of a stock. So anytime you do anything but with selling options on a stock, you should check if the stock has a dividend. Check when that ex-dividend date is. If you're selling options that expire on that week that the ex-dividend date lies on, you might either not want to sell any options, avoid selling options for that week, or you're going to want to close out 2 days prior to the ex-dividend date to avoid being assigned early and having to deal with that mess. So anyways, if you have any questions on the double bull spread here, feel free to leave it in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.